Hello everybody, and welcome to another daily plan. We have some major events coming out later today. We have the BoJ rate decision, which is for the first time expected to exit the negative interest rate policy, NERP. And we have the RBA, which is expected to hold today. So we'll be checking out some yen pairs. Maybe we'll be checking out some more Aussie-based crosses today just to check out what could be the moves for today. Maybe point out some spots on the week to pay attention to. Net on the dollar, things are moving so far as expected. A little better than last week. We had more bearish expectations last week, but that PPI came in strong, and things are still expected to move strong. As far as the dollar is concerned, there's kind of there is a net consensus that they're going to do at least 3 hikes, or 3 cuts rather. Misspoke there. 3 cuts this year, 3 25 basis point cuts this year. I think that does mean that there's some risk that the Fed doesn't cut so much, and that might slow down the US economy a bit too much. We'll see. So I'm still in the camp of wanting to expect 4. But then there's also a somewhat sizable chunk of people who are only expecting 2. B of A did a survey of 92 asset managers, and all these asset managers are global. It's about $1.2 trillion asset under management for all these 92 institutions that they surveyed. And they expect the Fed to sometime this year net move at least 3 times. And then the second most likely outcome was they're moving twice. When it comes down to expectations on the BoJ, those have been pretty well priced in. We can go ahead and check out the dollar yen first. And you can see the dollar has just been rising up against it. The yields went from super negative. The yield spread between yields in Japan versus yields in the United States. This is when the yields in Japan are moving more strong, or the yields in the United States are getting weaker relative to Japan. That seems to be most of the driver for this bearish move here. And you can even see how it got red before the fall off here. And then a little transitionary period from red to white and then to green. And the yield spreads are now quite positive still, at least on that time frame. And they're still quite positive here as well. It does seem like most of the positive yield spread, though, is coming from over the change in just the last week, though. So there's no, long-term change, no significant short-term change. It's been just changes over the last week have driven this. Now, as far as expectations go for the BoJ, probably not too keen on using these ranges. If the BoJ comes out and they do their hike, their 10 basis point, 15 basis point hike, and put us at ZIRP, which is the zero interest rate policy, yeah, makes sense that we could dive bomb, another 100 pips. Yen has been quite volatile recently. Let's go ahead and check out historically how this particular week has performed. And yeah, you can see down here, this is where you find most of your lows for a given week here, just for this particular week, week 12. We have 21 years of samples for this seasonal data here. And if we overlap it with a continuous distribution that samples all historical data, you can see this spot is kind of primo if you're a yen bull. So let's go ahead and check the risks to the upside. And it seems like most of the time, if I hide the distribution here so it's a little clean, you have these upshoots up here. We'll probably get that if they don't hike, but I think it's quite likely that the high is probably going to be in somewhere around here. So maybe this expectation was set just a tad too high going into the week ahead. because it's sideways, 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 and now we're getting the Bank of Japan coming out here shortly. So it's likely that when we opened the week and we tapped this spot here, maybe we tap this spot one more time, something along these lines here. One more up move, probably on this bar, color that green for up, and then we move down to those lows that were identified way down there, right? Somewhere, just call it in the mid 147 range. So that'd be about 150 pips of movement. Now, just because the BoJ comes out and they give their policy doesn't mean that this is exactly what's going to happen, because immediately after you have FOMC, so you could see some volatility on the move. Maybe we do get the chug down a bit, maybe into the 148 area. But I have some feeling that we're going to have a hang up when we're going into the FOMC meeting. So the movement this week, I think, could be staggered. Whereas you get like half of your bearish move on dollar yen during the BoJ meeting, and then you get the other leg of the bearish move during FOMC once they've confirmed mostly their dot plots. That's what everyone's looking for. It's consensus that the Fed's not going to do anything on their rates policy. People are going to be listening to what Powell has to say, and people are going to be listening to what their dot plots say about the future path of rate cuts. So with that in mind, and I'll just delete those lines, that's illustrative purposes. I would say down here would be a concern for a low. So I'll go ahead, set up a little rectangle around here. Can I color that red real easy? Yes, I can. And let's go ahead and timestamp that. And today's the 18th. There we go. So probably find a low somewhere around this mid 148 spot this week would be my expectation. Although next week you got some pretty high odds. Isn't that nice? You can see the week ahead odds. Yeah, and you got a little probability gap there too. So yeah, pretty good odds of hitting that R2 pivot next week. These pivots are going to move as the current price moves up and down. So these pivots will expand and contract and shift up and down. So as we get closer to the end of this week, we'll have a better expectation of where these odds will line up. And if you're a dollar bear, you'll want this thing to move as far down as possible. So then any sort of pull up into these higher probabilities next week leads you to either a lower high or some sort of equivalent high, establishing some sort of range going into end of March. Now let's go ahead and check out the other big headline number here, which is Aussie dollar for the RBA meeting that's coming up here. And so far, we're following the expectation of down. We got up on the very first 12 hours, and now we're still moving down a bit. We may not exactly hit that price, but you know what? Come FOMC, if they're saying we're going to do 3 25 basis point rate cuts going into the end of the year, and Powell still gives somewhat of a dovish speech, there's still a risk of going up higher here. Again, these are just the nominal expectations that I drew up given the data provided by these indicators. And you can see a lot of lows around here. So there's a risk that if the Fed comes out a bit more hawkish, let's say more people than expected are anticipating from the Fed. We know when Fed FOMC participants give their dot plots, if they put the median dot plot at 50 basis points at 2 rate cuts of 25 basis points, I'd actually expect us to trade somewhere down here, frankly. So you have this gap in probabilities seasonally. So most of the time this week, the low is somewhere around here seasonally over the last 21 years. Most of the time it's around here relative to pivot points. But during particularly hawkish FOMCs, heading down here can become a problem. And you can kind of see that also on the yen chart, which was those super high up odds. They were also quite low like this. One thing that Australia has going for it is that, what is it? I believe iron ore is making a slight recovery. I can't find that great of an iron ore chart. If someone could give me a decent ticker for like iron ore futures or some ETF that tracks the commodity prices of iron ore, I'd greatly appreciate that. But either way, I'd consider this down here as a risk to a more hawkish FOMC coming out, I believe, on Wednesday. So the way usually these gaps are traded is once price goes below these lines here, once it goes below that S1 pivot, never in the last 21 years have we found a low down here. That doesn't mean that we can't establish a new low here that we've never had in the last 21 years. It just means it's not that likely given the historical seasonal data. So usually the trade plan for these probability gaps is something along the lines of watching as this thing approaches this cutoff here at the edge of this probability gap, and then on the cross to get short, and then targeting these areas down here. So it would look more or less along these lines for a particularly hawkish FOMC. That's a risk that I see going into FOMC. If it's, the median dot plot is 50 basis points, which is actually not totally out of the question. And even if that's not the nominal expectation is 75 basis points or 3 rate cuts. This can still happen if Powell doesn't give good commentary during his speech. So there's a couple of things that can induce this type of move. And we can also color these things red for bearish. If I could just grab my drawings here real quick, set those to red. And we can timestamp these things as well. Let me go ahead real quick. Yep, set that one to red as well. 124.03.18 is the current date. And let's timestamp these things here. Actually, I'll go ahead and remove that expectation because still nominally, we set these expectations last week, see 03.15. So last week we had a week ahead stream and we drew expectations for all of the G7 currencies, for pretty much every major equity index, for the commodities, for some crypto stuff. Actually, I didn't draw expectations for crypto because I still expect it to do really, really well going into the rest of this year. And for crypto, you have a lot of parabolic exponential movement on its price. So you really got to be careful expectations on crypto discretionarily. You're better off kind of trying to watch that order flow and setting expectations off that. So it's a bit harder to set expectations on crypto, in my opinion. But we'll go ahead and be checking out crypto a bit later in the stream. It's just we have 2 major events coming up here for BoJ and RBA. So we're going to spend today focusing on those and the crosses. Gari Networks, I think you've mentioned that one before, Why Crypto. What, Gari USDT? What's that, OKX? Yeah, it's only got 2 years of data, so we can't really use that indicator. We can probably use the ranges. And it looks like for the week, most of the time you find your low right around this price here. Now, this is why it's important to follow central banks, even in crypto, because a lot of this stuff, even though it says Tether, denominated in Tether, it's tethered to the US dollar. So if you're not familiar with stuff like the dollar smile theory, dollar milkshake theory, growth inflation matrix, that sort of stuff, it's kind of important to follow what I call macro to micro views, where you start by looking at how the world is doing, then you go and you check out how each major country is, how their currencies and their bonds are. And don't get me wrong, a lot of people who trade crypto say that's maybe overkill in your analysis, but how liquid the markets are is relative to those factors. And that does play a role in how much money and what sentiment is currently doing risk-wise to actually allow for more investment in assets like crypto, especially sort of altcoins like this. And it seems to be doing pretty okay, but this is... oh my god, what a massive dump on that thing. It still hasn't recovered from that. Yeah, man. Not sure if it's really ever going to recover. You know, I have a few coins that I hold near and dear to my heart because I like the projects and I know the people involved in them on the crypto side. But you can never exactly tell when the things are going to pop unless you are intimately familiar with the supply demand dynamics of that particular coin, and frankly the social media aspect of it as well. Like, you have to know if it's being talked about a lot in social media, if it's going to get any sort of pop off that, if people are watching it. I mean, I have some like altcoins that I do have some bags in, but it's like these are projects from like more than 5 years ago, and it's really small amounts, so I really wouldn't call them bag. I'd call them like little purses, little coin purses. I don't even know if I still have access to those wallets anymore. They'll probably be on my computer somewhere. I'll have to see if I got them. Let's hop back into the main topics for today. Let's get into some of the major yen pairs. That's individual equities, currencies. How about Aussie yen? This is going to be kind of an interesting one, considering we have the BoJ and the RBA coming out today. Looking at this, it looks like the yield spreads are moving positively in favor of the Australian dollar. Yeah, outside of long-term expectations over the last week, over the last day, things have been improving for the Australian dollar. I'd say not so insignificant likelihood that the low is in. We just set negative expectations, frankly, on all these yen pairs. You'll actually see little drawings right here, time-stamped for last Friday when we did the week ahead stream, where I just set closing expectations on all these yen pairs for yen strength. And that would still be my expectation going into these meetings. Look, don't get me wrong, these things can still go up, but I don't have like the most keen insight on how flows are going to change. I mean, you go ahead and you listen to any commentator on YouTube or at these institutions in their outlooks, and the view seems to be the same. It's, we'll know when it's over. We'll know what happens when it's over. We can set some expectation using these tools, right? What's that? 26% of the time the low comes in right essentially off the open for this week over the last 19 years. And those are pretty good continuation odds, to be frank. Bullish continuation odds. And let's look at our high odds, but 42% of the time your top comes in here. So I don't know, I'd say past this spot here, I would start to get concerned of higher prices on against the yen, that is. That's where I'd be concerned, because then you're probably heading up here, or you're essentially guessing where the top's going to end up coming in at. Yeah, and you can actually see that there's a bit of overlap between the range probabilities and the seasonal data right here at this 15%. So you have a peak in where you find a lot of your tops for the week, for any given week with non-seasonal data. And then you slap on the seasonal data and you see, oh yeah, there is something there. Again, next week on this yen, those are quite strong odds of hitting that R2 again, just like when we looked at that dollar yen pair. So let's go ahead, check out the low distribution as well. Yeah, you can see there's some odds down here. Yeah. If I were to set my expectation, I'd say this thing goes down and then rallies into the end of the week. It's just really, really hard to set that expectation, because when you get into these meetings and you have a change in BoJ policy, there's also the BoJ speeches, and then you have the RBA speeches, and you don't just have to listen to the policy outcome, right? Whether they hiked, whether they cut, how much they changed their policy rate by. You also have to listen to the commentary and how that commentary impacts the future expectations for the rate path and the policy path for these central banks. So it's not so simple until it's actually done. You know, it's one of the reasons why a lot of people like to use robots to read those statements for them, and then generate some sentiment index from those robots, and then essentially trade in the direction of that sentiment. But then there's even more complicated robots that look at the flow and take that into account. So as discretionary traders, we really have to be careful with these sort of events, because there are these robots that can move much, much faster than we can. So it's really like a cautionary overload right now as we go into this week. I have a bit more hope later in this week, probably for the euro currency. So if we check out euro dollar, you can see we're heading lower. I did hop out of these two trades over here. That PPI really, I was so upset when that PPI came out, because I'm like, oh wow, look at that, I got the low for the week, and my drawdown was perfectly set. And then PPI came out and I'm like, great, now I have to, I'm still closing in the green. I still paid all my fees and came out on top, and I'm like, definitely, not totally happy, because these were great expectations from this week. And I was hoping that PPI worked out well. But you know what? When stuff surprises, you have to be ready, willing, and able as quickly as possible to change your expectations on new bits of information. So now this has made the view more mixed, at least on this particular pair. You can actually see this orange dotted line. I'll zoom in a bit more. This orange dotted line on the indicator is actually the probability weighted pivot. So if you take into account all these probabilities and you use them as weights against the pivot points, you get this probability weighted pivot line. And it kind of works like a weighted mean of this whole little histogram right here. And we can actually also look at the lows for the week. Yeah, so if you're particularly bullish, this would be the nominal place I'd think to look for a low this week. And if we pull up the drawings, you'll actually see that's all I did here. I just said, hey, nominally in the week ahead stream, you go down to here and you bounce up. But we're not going to take that for granted, to be frank. We can't take that for granted because we don't know what Powell is exactly going to say and how those dot plots are going to come out, whether they're going to be for 2 more rate cuts by end of year, 3 more rate cuts end of year, how hawkish, dovish, neutral Powell is. That stuff is all very, very important. Right now, first rate cuts expected in June for a lot of these countries. So there is some expectation that if inflation does improve and becomes less sticky as we get into April, right? As we get into next month, we will get the inflation report for March in the middle of April. And once we get that piece of information, hopefully it shows some more improvement on the quote unquote stickiness of CPI. The last CPI had an issue where, at least the US CPI had an issue, where a lot of the stickiness came from energy prices, believe it or not. And hell, we can actually real quick do a little review here on crude. Crude is going up and away. And today, as far as I'm concerned, I think I read something in the news saying Powell is not Powell, Putin. Switched up my P's there. Putin was like, hey, cool, you guys are doing rate cuts, OPEC plus, not rate cuts, production cuts. So production cuts are coming underway. There were targets way back here of heading to the $85 handle. That does seem a lot more likely now that OPEC has brought in more production cuts, essentially, or has said we're going to continue with the current production cuts in some of those countries. Some countries are going to be cutting some countries are going to be holding out some. Not every country has the same capacity to be so wild in their up and ramping up and ramping down of their oil production as a lot of other countries, like frankly, like Saudi Arabia and Russia have. So when it comes to oil, actually, we also have in the commodities section here, we also have gasoline. You can see gasoline has just been nutty, and this actually was a huge contributor to US CPI. And now this is going another 20 cents higher from the low in March. I mean, if we got sticky oil in our CPI just from, actually, yeah, there we go. There's like, where's the data? There's a big old gap here. And you can see this is why we had sticky oil and sticky energy prices in the CPI, because gasoline, it just did this like 10% jump in the middle of February. And now you're still seeing positive drift, really significant positive drift here. So if gasoline and oil prices don't at least flatten out from here, I still see risks that CPI actually stays sticky going into April. And this is making me concerned about my current expectations for a weaker dollar kind of starting in April. And it's going to have to push out those expectations closer to May, right? Maybe end of April, sometime in May. Because guess what? If this CPI, if these US CPI numbers stay flat, the FOMC's policy is going to impact how other central banks adjust their own policy as well, believe it or not. If the Fed holds, the FOMC can influence how the ECB, how the Bank of Canada, how the BoE. I mean, don't get me wrong, there are idiosyncratic things going on in those countries that those central banks have to be aware of and take into account. But they also don't want to be cutting as the US still has super high policy, because guess what? That creates a carry trade, a really strong carry trade, just for holding US dollars. People get then paid a lot more for just staying long the US dollar against these other currencies, and it induces a carry trade. So then instead of people investing their money into businesses like Nvidia, if I could pull that one up, Nvidia's been holding strong here for about the last week here. But if the dollar suddenly has this carry trade potential, man, it could actually hurt some of the opportunity costs that some of these investors have and say, well, we could just keep our money in FX and generate money as the dollar gets stronger and catch a carry on it too. Get essentially paid to be long the dollar as the dollar is appreciating. So there is a risk, and I believe the FOMC has pointed this out, that one of the major risks that they are trying to balance here going into the future is not cutting enough, frankly. But they can't cut until they see more improvements on inflation, on wages, and employment. And those three economic indicators are also kind of the mandate for all these other G7 central banks that have to be watched. Let's see here. What else can we check out? We can also check out New Zealand. New Zealand, so far this week, holding up nice and strong. The yield spread is really not in favor of, you can see how the yield spread got moderately positive here, and then it faded, turned red here on the yield spreads. And the yield spreads are simply the yields in the United States, when this thing turns red, are growing compared to the yields in New Zealand. And the rate of change in yields can push FX prices. It's kind of been a known thing for like the last 30, 40 years. Whenever you go and you read an institutional outlook, very frequently you'll see people model like, hey, the 2-year yield in the US against the 2-year yield in New Zealand continues to move lower. And that would be red on their charts as well. But we do something different. We do it against the entire gamut of available yields that's on TradingView. So you can see we have from the first year yield spread, the 1-year bond, all the way up to the 20-year yield. So we have a bit more information than they do usually, because they just usually look at the 5-year or the 2-year, and they leave it at that. But we try and look at as much information as we possibly can on that particular factor, at least on the FX side of things. That indicator doesn't work on, like, if you go to Nvidia again, like, you can see the thing doesn't work. Only works on FX charts. All right, let's head on over. Let's see, we already covered oil. Let's actually go ahead and check out gold real quick. Gold still holding in there. It's got a bit of a negative drift here. Last month, we said, hey, this is going to be our target. We did this at the very beginning of the month going into March. And then this is the first trading day of March, this big green candle here. In the first week, we're like, oh my God, we're already at our monthly target. Where could this thing go if the momentum continues? And then we highlighted this area here actually on the quarterly indicator part. So we set our expectation for up here, and we expected some more up and then down, down, down drift, and we got our down, down, down drift. So the expectation was met quite a bit sooner, frankly, I believe. And now for this particular week, it's down and then up into some close nominally. Again, this is another asset that can get hit if the Fed does, in their dot plots, say we're only going to be doing a median of 2 rate cuts this year. So those dot plots are going to be very, very important going into the end of, frankly, the month. Because we're not going to get another set of dot plots for like another 3 or so months here. Well, I check out, nah, man. I don't have time to be checking out crypto projects nowadays. I'm spending a lot of my free time programming this stuff, trying to work on new features for these things. And tutorials still. I've been quite busy last week. I haven't made as much progress as I'd like, but now this week has opened up a lot more for me. So hopefully you guys will see some progress on some of these works from me when you're in the trading group. And speaking of that, when you go to the link in the description, sign up for the trading group, there's like a 10-day free trial for it. You get access to all these indicators and the trading group and one-on-ones and da-da-da-da. Also, there's every Saturday a outlook review. So when I talk about these institutional outlooks sort of stuff, we get into a group and we review these things going into the week ahead. So then we're as knowledgeable as we can, at least as discretionary traders, about what the expectations are. Bitcoin. Well, took quite a bit of a hit here. Well, we eventually traded at this price at this time, it looks like, but man, that bearish expectation was just flat out wrong for the month ahead. And we definitely went a lot higher than here. I still think that there's room for Bitcoin to continue moving higher. Some people are going to say, oh, because inflation is sticky, Bitcoin should be going higher and have some positive drift. I think fundamentally, the positive, like exponential drift in Bitcoin has to do with its deflationary value as a commodity, how it's produced and all that. But also, I think BlackRock has acquired like 100,000, like they have a huge amount of Bitcoin now, BlackRock. So all this here, thank you, BlackRock. A lot of this is BlackRock coming in and acquiring loads and loads of crypto. And frankly, we're going to have to wait and see how this thing continues to perform. This thing easily can go higher into the end of the month. It can go sideways into the end of the month. It's very, very sentiment sensitive, frankly. So if people are not expecting dollar weakness, if people are expecting, for example, the S&P to fall from here, if people are expecting the S&P to fall from here, it does look like we probably hit the top for this week, frankly, on the S&P. Yeah, let's go ahead and check out the high odds here. Seasonally over the last 24 years, yeah. Don't get me wrong, there could be a bit more upside here, but going into FOMC, it's going to be quite tricky. In the news today, I think I got some stuff from the Wall Street Journal saying, hey, look at this. We moved higher today. We moved higher on the S&P. And then NQ. Oh, yep. Look, we moved higher on the NQ today. I guess traders aren't as bearish going into FOMC. No. Just because you have these sorts of pops going into FOMC doesn't mean that's the reaction to FOMC. The reaction to FOMC is what happens on FOMC. This is saying that this up move here during the first day is, bullish going into FOMC, that we're going to see more upside, more dollar weakness. That seems like a misinterpretation to me. That seems, or frankly, I think the correct term is over interpretation. People are reading too much into a singular candles day and its impact it could have on future expectations. So unless some new information came out about, the Fed's going to, Powell is going to give more dovish commentary, and somehow the markets learned about what his speech is going to say, and that we have close to 3 or 4 rate hikes, or rate cuts rather, getting priced into those dot plots. Yeah, that could be an over interpretation by the mainstream media on these major assets here. Let's see. We also have Litecoin. It's holding up. It's doing okay. It fell like pretty much everything else has over the last week. Litecoin's kind of holding its base here around the $80 mark. Yeah, over the last 8 years, most of your highs for Ethereum come in right around here. And this is also the all-time historical index on, I think, yeah, these are the all-time history indices on TradingView. Yeah, you can see a lot of your highs come in over here. And then all these crazy moves. Yeah, a lot of your lows come in here for the week. And then look, you got another gap like what we had on, I believe, Aussie dollar, right? Aussie dollar had a similar look. Yeah, with its gaps right here. So if I'm looking at this Litecoin and I'm seeing this, it's relatively going to be the same thing. And now you can see like, there's similar patterns cross asset on a lot of these things. Yeah, because guess what? They're both denominated in US dollar. Don't get me wrong, they'll have different performances against the US dollar, but the US dollar does have a weighting on these assets. Let's see, anything else to check out? Anything else to check out? Maybe euro dollar, maybe euro yen. Wow, those are some pretty uniform looking lows there. When I see stuff like this pop up on the indicator, this is essentially telling me, hey, you're just as better off guessing where the low is going to be for this particular week seasonally over the last 21 years. Next week looks a lot better. It's like close to 50% of your lows are really close to that central pivot. So that looks hopeful next week for, if you do move lower and you are closing lower here on these yens, that maybe there's some sort of recovery next week on these yens, at least for this euro yen. But again, I'm not going to be holding my breath here. Actually, I think euro yen's going to be one of the few that really gets hit. Going down to here is not all that crazy in my view. And also check that out. That's the probability weighted pivot. If you look at this, yeah, that's the probability weighted pivot. And on the range probabilities distribution, that's your 50%. And that 50% just tells you, hey, 50% of your probabilities are above this spot, 50% of your probabilities are below this spot. So this is the median of this whole histogram. And you can actually see the tails here go real low. Yeah, this is the fat tail part of your distribution. It only goes out to 1% because otherwise the thing would draw out to infinity. So yeah, this would be the quote unquote nominal expectation, I think, for the low, given the current bit of information that I have. And again, most of your closes are somewhere maybe around here. There's some risk of finding your close down here. So if you do move all the way down, and for euro, there's actually something interesting. You have flash PMIs coming out, and flash PMIs can improve going into the latter half of this week. So for the euro particularly, I'm going to be watching how those flash PMIs perform. In fact, it seems like we're going to be getting flash PMIs for pretty much all the G7 countries and the world. And those flash PMIs move assets. They do. And I'm quite surprised how few people who trade retail, day in, day out full time, just don't pay attention to those flash PMIs, because they do have significant impacts on future expectations, because they do lead GDP, they can lead CPI, they can lead components of CPI, and they're used in a whole lot of different modeling. PMIs are used as features for all sorts of different kinds of modeling. Okay, anything else interesting? Yeah, we can check out ARK. ARK has been holding flat. Seems like it's been holding up from its crypto holdings. And most of the world's equity indices have been positive so far on the day. Actually, right here, this is a custom index of the top 10 holdings in the S&P 500, weighted by how much the S&P 500 holds them. And you can see nice little positive drift. And we had a little gap up in this custom index today. I don't try and follow, the Magnificent Seven, or I think Magnificent One now at this point. I'm just like, okay, what are the top 10 most important companies in this index and in that index? Now let's just make a sub index and look at those things. And I think this makes sense when you want to look at those, at the strength of the most powerful or the most profitable or the best companies in a particular index. Just take off a particular quantile or a particular set of them and weigh them properly. I may need to update these weights now, because this is quite an old index and we've had quite a bit of movement now in the S&P, so maybe it's time to update this index. Okay, that's pretty much everything that I wanted to cover here today. I'll go ahead and say thank you all so much for watching. I know the stream went on for close to an hour here, so I appreciate everyone tuning in. And again, feel free to go ahead, like and share it. Gonna go ahead and try and grow this stream and at least spread the view that, hey, setting expectations, even if you're wrong, share your expectations, draw them on your chart. Make it so that then people don't have to watch like a billion different videos from your history just to see how you've changed your expectations over time. Like during February, I was really on top of it. And then here during March, I'm like, oh, whoa, this is nutty. And oh my God, you could go down here. And sometimes expectations are really on point. Sometimes expectations get wildly mismatched. And sometimes I'll set expectations for something other people will be like, no, dude, that's crazy. And then the expectation gets set, and it's nice to have a little line with a timestamp on it. It can be really fun to actually set these expectations and see how frequently or when you're right or wrong on your expectations. because changing your expectations over time is a really important and key feature, I believe, to actually becoming a better trader. You have to know what the current expectations in the market are and how those expectations can change going forward. And then look at the upcoming risk events and figure out, okay, if this event comes out good, my expectation would be this. If that comes out bad, my expectation would be this. And then trying to react discretionarily on those expectations. And hopefully that makes sense to you guys. That's just stuff I've picked up from, frankly, it's the one unifying piece of advice I've found from pretty much all major and significant and successful traders throughout history, is that one bit about expectations. So it's the one thing I try and talk a lot about. Oh, I already talked about my BoJ expectations. It's essentially they're going to do their rate hike, and it'll make the yen get stronger. So into the end of the week on, for example, a lot of these yen pairs, I have net bearish expectations. The New Zealand yen seems to be improving there on the yield spread here. A lot of these yield spreads are still quite positive against the yen, but those Japanese yields are going to bump up higher. So while the yields currently for a lot of these FX pairs are green, going into and post the BoJ meeting, when they do their hike, I mean, we could just go ahead and look at the bond yield here for Japan. Actually, I do have another layout here. Here's JPY. So here's J10, here's J2. So this is the 2-year yield. You can see nice, huge positive drift over a long period of time here. And this can continue to rise, and this can continue to rise, even though this has been relatively flat here on the 10-year. So if these yields continue to rise and the yields of other countries remain the same, what you'll end up with is a bunch of red candles here, because the yields will be now changing in favor of the yen, and you'll have the rate hike come in. And look, just because it's quote unquote priced in and everybody knows that it's happening, quote unquote, doesn't mean that you can also expect the type of move that will come on the announcement, on the change when that actually occurs. So we can set some nominal expectation of how this thing will move. But unless you have a good model of how the flows are expected to turn out, becomes a bit harder to set like the most super precise ahead of time expectations. I mean, I'm sure there are some other ways of modeling this out there for sure. But when you're doing things discretionarily, you have a lot more uncertainty, so you have to be a lot more sure-footed in your data and in your expectations and understand how those things changing can impact how things currently look on the charts and how things currently look in the data. Just because you have green here on these bars, right, from these yield spreads coloring this thing, right? That's what's coloring these. Doesn't mean that you still can't get red bars as this thing is green. You know, there's plenty of examples like in this uptrend of, hey, these are some red bars, but the yield spread is still positive in favor of euro instead of the yen. And then positive for euro, negative for euro, positive for yen. Negative for euro, positive for yen. And even you can have some green candles when it's red as the yields try and adjust to new information that's come out. So these things can flip on a dime, and a change in central bank rate policy can induce that, because it'll also move those yields at the same time. So I do have bearish expectations for these yen pairs, so bullish yen. But then again, if you go and you read any outlook from any institution, they're gonna effectively be telling you the same thing. One of the favorites, frankly, has been Swissy yen. And man, I called this thing out like way back here. I'm like, dude, a lot of people going into March are super, super bearish on the Swissy yen. And now this thing is 400 pips. Makes me wish I had decent leverage on yens. You know, it's something I say frequently. Oanda doesn't give you the best of leverage here on the yen pairs. But you know what? For the people who can take advantage of it, I'm pretty certain that they're enjoying it. And a lot of the people who were giving this expectation of lower Swissy yen, they're still bearish on this thing. They're still they're like, hey, down here to like sub or towards the 165 mark. Like, people are particularly bearish because the Swiss National Bank, the central bank here, is actually cutting rates, if I recall correctly. So as you have a bank that's hiking rates, the BoJ, and a bank that's cutting rates, the SNB, now you're having this divergence, and this can set up for particularly good appreciation for the country with the central bank that's hiking. So for FX purposes, this is all well and good analysis. This is all well and good. Okay. So now I think I've said everything I want to. Thank you very much for the question, my man, Ann. And yeah, I think that's it. I'll go ahead and I'll see you guys in tomorrow's stream. We'll be reviewing some of the commentary that I just gave today for tomorrow and actually look at the playthrough. And I am I'm quite uncertain about exactly how prices are going to move, so I would say my expectations are quite flexible right now, but I'm setting down some nominal expectations. I'm ready, willing, and able to change them. And I've, in anticipation of that, hopped out of positions like this euro dollar here. Like, again, that PPI, you know, my woes, right? Anyways, let's go ahead and follow up tomorrow. I'll see you guys in a bit.